This
edition.
conference will now be recorded.
Start over. Welcome to this month's edition of Integrity University. Our topic this month is living a charitable legacy. We appreciate you participating, and thanks for your patience as we worked out the technical difficulties. My name is Jeff Gott. I am a certified financial planner and senior financial advisor with Integrity Wealth Advisors, and this is a topic I love. My passion for many years has been to help clients grow their wealth and invest in a legacy that will outlive their lives, and to do it tax efficiently. It's my pleasure today to be joined by my professional colleague, Michael Acapenti. Michael is a senior gift planning advisor with Wycliffe Foundation. Michael earned his bachelor's in business economics from UCLA and a master's degree in taxation from the University of Southern California. Michael has over 3 decades of experience in the charitable gift planning field. His mission is to assist people in using their assets for charitable impact through creative charitable gift and estate planning strategies. Thanks, Michael, for being here today. We're in front of a live audience as well as a remote audience. We'll take questions from the live audience throughout. If you want to ask a question and you're on the remote broadcast, there's a chat feature. It looks kind of like a thought bubble. You can send in your questions, and Nikki is here on site, and she will filter those questions. And Nikki, I'm fine to be interrupted to ask questions if they come in. So feel free to ask questions as we go along. So for today's presentation, I'll speak first. This is Jeff Gott, and then I'll turn it over to Michael Acapenti. As far as what we're going to cover today, the topics, I'll be covering generally about giving and how giving intersects with wealth management. But the bulk of my presentation will be on best practices in giving. That will be the takeaway point that I think will have the most meaning to you. I'll turn it over to Michael to talk about recent legislation that has impacted charitable giving and will be very informative and very current. The things I'll talk about aren't necessarily timeless. Some of them are, but have been in place for a while. The things Michael will talk about are very much more current based on current legislation. Before I begin, I want to start with this question, why give? It may sound like a rhetorical question, but it's not. It really deserves our attention. It really deserves some thinking. And this crazy year of 2020 may provide the perfect backdrop for this question, why give? In the midst of COVID-19, one thing seems clear. We're all in the same storm. We're not all in the same boat. We're all impacted, but we're all impacted differently. Old versus young is a clear distinction. The older generation has been much more impacted than young children. Economically, the technology sector has actually thrived this year, whereas the hospitality sector is on life support. So it's very different how we're being impacted. Certainly, we're all in the same storm, but we're not all in the same boat. When the stimulus funds came out in the springtime from the government, some saw them as a lifeline. Others felt it was gratuitous. It was almost a binary response. But when one who has excess sees their neighbor suffering, voluntary giving is a reasonable response. I think you'd agree with me on that. So the question, why give? Because giving makes us human. It makes us more human. I love this next quote Unfortunately, I don't know who originated it, but let me read it. You make a living by what you earn. You make a life by what you give. For the longest time, and many sources on Google would say this was attributed to Winston Churchill. I don't believe he ever said it, but I do believe the quote is true. I believe that giving gives definition to our life. In fact, I would contend that the greatest beneficiary of our giving is not the recipient, no matter how desperate the need is for the individual or the organization. I would say the greatest beneficiary of our giving is the giver. No less an authority than Jesus himself said, it is better to give than receive. So, why give? Because it provides us a life that's worth living. But if you need something more homespun, here's a farmer's perspective. Money's like manure. If you pile it up, it starts to stink. But if you spread it around, it can do some good. That's from my friend Jess Carell, who's Kentucky through and through. So today, Michael and I will tell you ways to give tax efficiently. That's really going to be the focus of the presentation. But at the heart of the presentation, and certainly I know Michael in my heart would say this is true, it's that generosity itself is worth pursuing because it makes us more human, it creates a life that's worth living, and frankly, the opposite just stinks. All right, so we're going to jump in with this graph about charitable giving and wealth management. And we're going to start at noon on your dial with tax planning. And this is the one that makes the most sense to people. Because of the country we live in and the tax laws written the way they are, charitable giving definitely impacts tax planning because a charitable gift to a qualified charity creates a current tax deduction. And while that's not the reason we hope people give, it's certainly and absolutely true that it exists, and we want to take advantage of everything that the government will give us in terms of minimizing taxes, and charitable giving does that. But move over to the 1 o'clock position, investment planning. So at this time of the year, wealth advisors talk a lot about tax loss harvesting. The idea of tax loss harvesting is that if you've had a dog in your portfolio, we might suggest we go ahead and lock in that loss to offset other gains, to minimize taxation on those gains. Or if the losses exceed the gains, some of that is tax deductible. Well, the same is true for harvesting capital gains. So tax loss harvesting, capital gain harvesting. But capital gain harvesting is where charitable giving fits in. And we're going to talk about harvesting of appreciated capital assets here in just a minute. In terms of business planning and charity go very well together. And in fact, business owners are probably in the best position to be able to take advantage of some of the charitable tools we're talking about, whether it's a pre-liquidity strategy before they sell a business, whether it's gifts of their closely held stock, or whether it's business succession planning, transferring from generation 1 to generation 2. Charitable giving can have a large impact on minimizing the taxation of any of those situations. Down at the bottom at the 6 o'clock, income planning. I'm going to talk very briefly, Michael will talk a little bit about charitable income solutions. So charitable tools that actually create income for the giver as well as a tax deduction. Estate planning, probably the biggest impact that charitable giving can have is on taxable estates. I say it this way, you can give to your favorite charity, you can't take it with you. If your favorite charity happens to be Uncle Sam, they're going to take it. If you want to give to another charity, you can do it. It's within your power through estate planning to avoid estate taxes. But with the estate hurdle being at around $11 million per person, it doesn't apply to as many people as it once did. Still very important. And then finally, retirement planning. the idea of required minimum distributions from traditional IRAs and qualified charitable distributions to charities from those traditional IRAs is actually going to be the first topic of my best practices. So in terms of best practices, I'm going to talk about three. The first will be the qualified charitable distributions. Then I'm going to talk about a topic I call bunching or bundling of charitable activity. And then finally, giving of appreciated capital assets. So let's start with qualified charitable distributions, or QCDs. All right, well, what's the issue? If you're 72 years of age or older and you own conventional IRAs, which many do, then required minimum distributions are inevitable and taxable whether you need them or not. Now, these particular funds, traditional IRAs, are best not to leave to your heirs because your heirs will be taxed on them. And Michael may touch on the current legislation that they'll have 10 years to be able to draw those monies out after they pass. Well, it's very likely, certainly possible, that their tax rate will be higher than your tax rate. And so that taxation on these when passed to heirs is not a desirable thing. So the question is, are there ways to avoid taxable distributions on your RMDs during your lifetime if you're a giver, and specifically over 72 years old? And the answer is yes, and the process is through qualified charitable distributions directly from your IRA to the charities of your choice. So, what's a QCD? Well, a QCD permits taxpayers who are, interestingly, not 72, 70 and a half. I won't get into the vagaries of why, but trust me on this one. It permits taxpayers who are 70 and a half years of age to contribute up to $100,000 per year directly to qualified charities from IRAs. Okay? Now, why is that a big deal? Well, it's a big deal because it fulfills the required minimum distribution. And so if you don't need the money, but you're required to take the money, it's really the only exit ramp you've got to not hit your income. In this fourth bullet point, distributions are excluded from your income altogether. Therefore, when you're filing your taxes, one of the big important numbers on tax filing is your adjusted gross income won't be impacted because the money's not coming to you. It's actually bypassing you. So rather than you taking a distribution from your IRA and turning around and writing a check to a charity of your choice, you're bypassing your income altogether, going directly from the IRA into the charity. Okay? And that affects other calculations like Medicare. I skipped over bullet point number 2, but it's an important one. This was made into permanent law in 2015. Which was the Obama administration. So this law is unlikely to be changed, and it's a very powerful way to avoid income if you don't need it, especially if your desire, if you did receive that income, would be to give it to charity. Now, there's no deduction, so you don't get a tax deduction on your current year taxes because you're not receiving the income. But think about it this way. The money went into the IRA untaxed. It's grown over the years untaxed, and now it's transferring to the charity of your choice, and they won't pay tax on it. So it is truly an amazing thing that the government allows, but don't be fooled to think that you can give to the charity and get a tax deduction because that money was never taxed to you in the first place. We're going to talk about donor advised funds in a minute, private family foundations. Neither one are eligible for receiving these qualified charitable distributions. So just be aware of that. But otherwise, qualified charitable distributions truly are a great way to give if you're over 70 and a half. Yes, we got a question?
Qualified charity, 501c3.
Great. Yeah. So the question is, what is a qualified charity?
Yeah.
Yep. And so 501c3 is the designation the IRS gives them. The charity themselves has to go through a process to get that designation.
It has to be a 501c3.
That is correct. 501c3. Great. Good question. Thank you. All right, so back to bunching. All right, I'm sorry, moving on to bunching. This is the second best practice in giving. So this stems from the Tax Cut and Jobs Act, which passed in President Trump's administration. And one of the things that happened was the increase of the standard deduction. So making itemized deductions less necessary and less likely. Forbes actually, shortly after the law was passed in January of 2018, wrote this: among those making between $86,000 and $150,000 a year, the percentage of taxpayers itemizing their charitable gifts will plummet from about 39% to 15%. And I haven't seen the actual numbers to verify that, but anecdotally, I would say that is absolutely true, that itemizing deductions really stopped happening in a big way because of the Tax Cut and Jobs Act, and specifically the raise of the standard deduction. So the question is, with the standard deduction this year, 2020, increased to $24,000, $24,800, and $26,100 if you're over 65, can I get a tax deduction for my continued charitable giving? Or said another way, I'm not itemizing. How do I get that charitable deduction? Well, the answer is yes, you can take advantage of continued charitable deductions by bunching your giving into a single year through the use of a donor-advised fund. Now, this is the second time I've used the term donor-advised fund, so I think now would be a good time to pause and explain what a donor-advised fund is and how it works. So a donor-advised fund is a qualified charitable instrument. In other words, when you give to it, you're eligible for a tax deduction. So that question of, is it a 501c3? It's under the auspices of a 501c3 public charity. All right, so we're walking through a picture. We've got a couple here who's going to give to their donor-advised fund. Because it's a tax-exempt entity, they are entitled to a tax deduction in the year of the gift, just as if they had given to any other public charity that was eligible. Okay, so they get the tax deduction in the year of the gift. It goes into the donor-advised fund, and it can sit there as long as they want. They can give it out of the donor-advised fund the very next day, or they could wait 10 years and give it 10 years from now. There's no requirements for distributing annually from the donor-advised fund. But when you're ready to distribute from your donor-advised fund, it can go to the churches, charities, and ministries of your choice. While it sits in the donor-advised fund, it can be managed by your professional money manager. So the big advantage, especially as it deals with bunching, is timing. The reason people use donor-advised funds, or one of the reasons people use donor-advised funds, is to match their giving with their income for a year. So if you've got a big income year and you don't know where you want to give and 12/31 is coming upon you, a donor-advised fund is a good place to store that money. And in that sense, I call it a giving bank account. So just like 75 years ago, you didn't necessarily have to have a checking account. Certainly having a checking account makes life a lot easier to have a single repository for all your inflows and outflows of money. Well, same thing with a donor-advised fund. It just simplifies giving by being a single repository for putting your giving dollars into and then distributing your giving dollars to charity. And the timing of the inflow can match the tax year you want it to, but the outflow to the ultimate charities is up to you. It can happen this year, it can happen next year, or a future year. And while it sits in the donor-advised fund, it can be invested. So this really simplifies giving. Another big advantage, and we'll talk about this in just a minute, is what you can put into a donor-advised fund. So whether it be stocks, whether it be real estate, whether it be closely held business interests, all those things are generally available to be put into a donor-advised fund. A lot harder to give that directly to charity. But maybe the biggest opportunity is this idea of creating a legacy. So if you're using a donor-advised fund or a giving bank account, you've got now a repository of funds that have to go to charity. They can't come back to you. In fact, when the gift is given, the reason you get an immediate tax deduction is because you've given up ownership, custody, and control of those monies. But the way a donor advised fund works is you, as the donor advisor, instruct the custodian to send it to the church, charities, and ministries of their choice. And if they don't, they probably won't be in business for very long. So you've got this repository of dollars, and I say it can be used to create a legacy. Bring the family together around the Thanksgiving table and say, we've already allocated this money for charity. Where do you think we should give it? And begin a discussion and allow younger generations to be challenged with that idea of the responsibility of giving money away. I've heard of families who, when their children go off to college, say, hey, we've got this money in the donor advised fund. I'm going to allow you to give up to $1,000 a month to any need that you see, any charity need that you see out there. It just has to pass through me, but we've got the money in the donor advised fund ready to go. And so it encourages the child to start having eyes to see opportunities to give monies away. But back to the idea of bunching, it's the timing issue of being able to match the tax deduction with the year of the income, but not being required to distribute to the charities of your choice that makes bunching work. So here's the issue. With a higher standard deduction, how can givers capture tax benefits for their charitable giving? Well, the solution is, first, open a donor advised fund. Second, pre-fund your giving by combining multiple years of gifting into one tax year. And then that allows you to itemize in that chosen year and restore some of the charitable tax deduction, even though the standard deduction has been raised. Okay, so I think an example is going to be the easiest way to show this. The Smiths give $10,000 every year to charity, like clockwork. Until 2018, they itemized their various tax deductions, their charitable giving, their state and local taxes, also known as a SALT deduction, their mortgage interest, etc. But then starting in 2019, with the standard deduction elevated, they did not itemize and received no extra tax benefit. By bunching 2 years of giving this year into their DAF, the Smiths will benefit from itemizing this year. Then they'll take the standard deduction next year, and they'll rinse and repeat, bunch in 2022, and use the standard deduction in 2023. So I'm going to show this using a chart. Don't get upset about the complexity of it. I'm going to walk you through it. If you start at the top line, this is without bunching. So this is what they would be doing otherwise. Their charitable deduction every year, $10,000. And then the other deductible item they have is their state and local tax deduction of $10,000. Well, combined, that total itemized deduction is $20,000, which is below the standard deduction of $24,800. It will increase slightly. That's why I've got the asterisk in future years, but not significantly. So $24,800 is about right. So the deduction they'll utilize in 2020 is the $24,800. If they're in a 29% marginal tax bracket, that's state and federal combined, then that benefit that they get from that standard deduction is just a little under $7,200 a year. And over 4 years, their total tax savings, $28,760. And that's what, again, the Forbes article would say, maybe 15% of the people will do something different. The majority of the people will take advantage of this exact scenario, okay? But if they look at this and they think of it through a tax lens, they might say, well, wait a minute. If we didn't give the $10,000, do we get any additional tax benefit or any less tax benefit? No, it's going to be the same because you're utilizing the standard deduction. So now we talk about bunching. So I'm going to start with this bottom line, $28,760. On my next slide, if you'll look at that same line, we're at $31,780, an additional $3,000 in tax savings. How'd they do it? Go back up to the top line. Their charitable deduction has been bunched in 2020 to cover 2 years of giving. In 2021, no charitable tax deduction. 2022, again, they bunch it for 2 years. Now, that doesn't mean the charity's getting it because they're putting it into their donor advised fund and giving away $10,000 a year each of those 4 years. They also still get the SALT deduction, just the state and local tax deduction. So their total itemized deduction in 2020 and 2022 is now $30,000, and that exceeds the standard deduction of $24,800. So in those years, 20 and 22, the deduction utilized is $30,000. The off years, it's still $24,800. And at 29% marginal tax rate, they get about an additional $1,500 benefit in those years that they bunch. So now the total tax savings of $31,780, or in red down at the bottom, the tax savings increase is 21% in the years that they bunch. They don't get any additional tax benefit in the years that they don't, but because of the higher standard deduction, they still get a nice benefit from that. So this idea of bunching using a donor advised fund helps kind of keep the giving smoothed out to the charities, but allows them to take advantage of at least every other year getting a higher tax deduction and making their charitable deductions seem like, hey, it is important that we continue to do this from a tax perspective as well as from a heart perspective. All right, the third of my best practices is capital asset giving. And really, this is a big one. So I'm going to spend some time on it, but for our purposes, a capital asset is defined as an investment that's appreciated and been held for longer than a year. So that's how I'm defining capital asset giving. If you have an asset that fits that category and you sell it, the government wants to tax that. So you're going to pay a capital gains tax. And right now, that tax is between 15 and 20%, depending on a number of things at the federal level, plus 4.63 at the Colorado level. I'm just going to round that up to 5 and give you an example. Let's say you bought Amazon at $1,000 a share in 2017, and then this year you sold at $3,000 a share. So you've got a $2,000 capital gain, good for you, but you're going to have to pay tax, and using the 20% federal, 5% state rate, 25% on $2,000 is $500. So you owe that to the taxing authorities. But you got $3,000 when you sold it. You're going to pay $500 to the taxing authorities. Net, you've got $2,500 in your pocket. But that's how capital gains work. And the big idea here is that individuals pay capital gains taxes. Nonprofits do not. That's the idea. All right, so let's take a look at a typical asset portfolio here on the left. Most people, middle class and above for sure, hold about 10% of their assets in cash, about 90% in things other than cash. Maybe it's securities, maybe it's real estate, maybe it's business, but they generally aren't stuffing cash under their mattress, they're putting it to work. But if you look at a typical giving portfolio, 80% of giving is done out of cash. Maybe 20% gets done out of other assets like securities, real estate, and business interests. But that's probably being generous. It's probably closer to a 90-10 split. So if Americans generally have 90% of their wealth in non-cash assets, why is most giving being done out of cash? It kind of doesn't make sense. Add to that individuals donate about $250 billion every year, year after year after year in the United States using cash. That is a big number, $250 billion. And the problem is, to get that cash, since they're not holding it in cash, there's a likelihood at least some of them are selling capital assets to get the cash to write the check to the charity of their choice. But every time they sell a capital asset, just like we saw in the Amazon example, they have to pay Uncle Sam a share. Unnecessarily, I will add. Because selling appreciated capital assets to write checks to charity triggers that 15 to 25% in capital gains tax. And it's a multi-billion-dollar inefficiency. I call it leakage, that someone who is already made the decision to give this money to charity, but in order to get the cash to write the check to charity, they have to sell a capital asset. Some of that is coming in the form of a capital gains tax that has to go to the government unnecessarily. I don't have hard figures on this, but I would say it's about a $20 billion annual leakage problem. So it's a big problem, a big inefficiency. And what I say to solve the problem is stop writing checks to charity. Now, that doesn't mean I'm anti-charity. It just means there's a better way to give it to charity. Let's take a look at a scenario, and I think it'll make sense. Let's say someone who's making $350,000 a year wants to make a $100,000 fair market value capital asset gift. They could give cash, but they're smart. They know, hey, I'm going to avoid the capital gains if I don't. So they're wanting to do it. And we're going to assume a zero cost basis, but that's simply to make the math easy. The owner's willing to give the full after-tax value to charity, but he does want to get the maximum benefit. Let's assume he's got a capital gains exposure of 25%, state and federal, and he's got a marginal income tax rate of 35%, state and federal. So we're going to take a look at what happens if he sells the asset and gives the cash versus if he gives the capital asset. So first, he's going to sell the capital asset, give the cash. So sell the asset to get the cash to write the check to charity. He's got a $100,000 asset that gets sold. He's in the 25% capital gains bracket, so he's going to pay $25,000 to Uncle Sam in capital gains tax, but he's going to have $75,000 left over, which he sends to charity. So charity gets the $75,000, and he's entitled to a tax deduction on that $75,000 gift at his marginal tax rate, which is 35%. And so he's going to get effectively $26,250 of benefit from giving that money to charity. So the charity's happy. They got $75,000 they didn't have. The giver's happy. He feels good about the gift that he's made. And Uncle Sam's happy, or the taxing authority's happy, because they got $25,000 for doing nothing, right? So everybody's happy. It's a trifecta. Is there anything better than that? Well, in fact, there is. Because if he had given the $100,000 asset to the charity and lets them sell it, there would be no dollars going to the IRS in that transaction. And he would give $100,000 to the charity, and the charity would get $100,000 worth of benefit. Well, because it's $100,000 instead of $75,000, his tax benefit, his marginal tax rate of 35, is now $35,000 instead of $26,000. That right there would be reason enough to do it. But the story's not over. Remember, he also avoided a $25,000 capital gains tax because the charity's not going to pay it either. So all told, $60,000 in benefit simply by giving the asset rather than selling the asset to get the cash to write the check to charity. That's why we say stop writing checks to charity. And when you multiply this by the $250 billion of cash gifts that are given to charity year after year after year by generous Americans, realizing that some portion, I don't know what portion, of those monies are coming from capital assets that are being sold and paying Uncle Sam unnecessarily, leakage is a real inefficiency in the supply chain of funding charities. Yes?
I have a question regarding your second death question.
Okay.
Does the charity get the money every year, or is it they only get the $20,000 every other year?
Yep. So the question was back on the bunching example, and using a donor-advised fund, even though you're putting $20,000 in, say, this year, it will be up to you when you distribute those monies. And if you want to keep a steady stream of $10,000 going to the charities of your choice, you give $10,000 this year, so $10,000 is left in the donor-advised fund. Next year, you give another $10,000, bringing it down to zero, you refund in 2022. It's up to you. If you wanted to just give directly to the charity the $20,000 in 1 year, it would have the same effect, except charities tend to forget. And so if you give $20,000 this year, likely you're going to get a call next year wondering, hey, are you going to give us $20,000 this year? Whereas if you keep it consistent at $10,000 using your donor advised fund, you both get the tax benefit and the charity gets a consistent stream of income, which is helpful for the charity too. Okay, great. Well, those cover my three best practices: qualified charitable distributions, bunching, and giving out of capital assets. I just want to touch on one more thing before I turn it over to Michael, and that's giving tools. And over on the right-hand side of this, you see a number of different tools that are used. And I use this spreadsheet or flow chart to help me keep it straight. If someone's willing to make an outright gift, they're not going to get any income, but they are going to get the highest tax deduction. We just saw an example of that. And that's going to be where you would use a donor advised fund or a private family foundation. But if they need, or if they have the ability to give a larger gift, there's other tools to consider. But let me just refresh you first on the donor advised fund. Again, they give the gift, they get the tax deduction. Over time, they distribute to the charities of their choice. So that one we've already looked at. But now I want to go down and say, okay, you could give $10,000 this year, but you actually have the ability to give $100,000 this year. Would you consider doing it? And the hesitation often is, well, what happens if? If I give $100,000, what happens if next year or 2 years from now I need money? I can't get it back. And so this idea of, well, would you give a larger gift if you could get income back from it? And if so, do you need annuitized income where you know it's going to be the same amount every year, or variable income or market-based income like you get from your investments now? And many people will say, no, I could give a bigger gift if I knew there was income associated with it. Okay, well, that's this bottom line of income producing charitable tools. And I'm going to focus on the charitable remainder unit trust. All right, so the idea here is givers, and this picture should look quite similar. The givers give to the charitable remainder trust. They're going to get an immediate tax deduction in the year of the gift. It's not going to be for the same value as if they'd given it outright for two reasons. One, the charity is not going to get it for a number of years, but most importantly, because of number 4, they're entitled to income off that gift for a term, whether that term is a period of years or the second death, it's up to them, but they're going to get that income for the rest of their lives, and they get to determine by the writing of the trust document what that income is. It has to be at least 5%. So if they put $100,000 in, they write a 5% charitable remainder trust, they're going to get $5,000 a year or get 5% of whatever the corpus is in that trust each year. And then after the end of the term, whether that be a term of years or when the second death happens, then that money flows to the charities of their choice. So it's a deferred gift to charities, but it's deferred because they're earning income off that every year. And oftentimes, just this simple idea of, hey, if you could get income off that gift, would you make a larger gift, helps people to say, yeah, I would. And then in the year that they receive the income, they can say, you know what, I really don't need the income this year. I can gift that or never receive it, kind of like a QCD works. But this is an idea that Michael's going to touch on in his remarks. So I'm going to turn it over to Michael to give us a charitable giving update on the CARES Act and the Secure Act. And I'm going to go to mute. And Michael.
Well, thank you, Jeff, and good to see you all. And whether it's in person or I guess you can't see me online, but I'm there in spirit. So Jeff asked me to touch base on just a couple of tax laws that were passed in the past year in response to COVID and how that affects charitable giving. There were two, the CARES Act and the Secure Act. And so we're going to start with the CARES Act. Here we go. And this is just for 2020. This is a very temporary thing, but they adjusted some of the tax code in the following ways. For folks who do itemize and make cash contributions, you now can deduct up to 100% of your adjusted gross income. Just think about that. You can give away all your taxable income. I guess the question is, can you afford to do that? I know I can't, but that is out there. That is reduced by other itemized deductions like taxes, or if you have a mortgage like I do, the mortgage interest. But again, the idea, theoretically, you can deduct 100% of your adjusted gross income this year. It doesn't apply to donor advised fund gifts, which Jeff did a great job of talking about. That's still limited to 60% of your adjusted gross income. But These are still a wonderful way to, as Jeff described, if you have a income windfall, it's a great way to put a lot of cash, get that tax deduction now, and then take more deliberate time to make, giving decisions in the years to come. And a nice little benefit, they threw in something called the universal tax deduction for all of us. You get a $300 above the line reduction. That's kind of on the front page of your tax return, which reduces your adjusted gross income. That's for everybody, and hey, every bit helps, right? For appreciated assets, they kept that at 30% of your adjusted gross income, so that hadn't changed much. But as Jeff described, giving appreciated assets is really a wonderful tax planning way to give, because not only do you get the income tax deduction for the full fair market value, you get to avoid the capital gain taxes. When I was getting my degree in taxation, one of my favorite professors said is, tax evasion will put you in jail. Tax avoidance is legal. And we're talking about tax avoidance here, where you can avoid capital gain taxes and double your tax savings. Just some planning ideas. Some folks have said if you can do both, give up the 30% adjusted gross of appreciated assets and give the other 70% in cash. Depending on your tax situation, it can be a good way to combine both of these tax laws. Going on to the next page, if you own a C Corp, they change again just for 2020. They've increased how much you can give to charity and deduct it. They increase it from 10 to 25%, which is a nice little benefit. You may ask, well, what if I own an S Corp or an LLC? Those are pass-through entities, so it doesn't really help you there. And Jeff touched on the last point, the qualified charitable distributions. The law still allows that. And in my opinion, that's probably one of the best ways to give cash, because it doesn't affect your cash flow. And if you don't need it, why declare as taxable income by just giving it to charity directly? You have to give it to charity directly. It's not reportable as taxable income, and that's even a better tax plan. And so that is out there. And I think there was a question about, Ted, you asked, 501c3s. That's it. I actually talked to a person yesterday who wanted to give one to a 501c4, and you can't do that. So it has to be a public charity. But again, qualified charitable distributions are probably the best way to make a charitable contribution to your favorite charities. And again, the biggest reason is you don't report it as taxable income. You also don't deduct it, but not having to report it is a better result. The Secure Act, it didn't affect charitable giving in a current sense, but it doesn't have a big impact as you look at estate planning and some charitable strategies. First of all, it did increase the required minimum distribution age 72, which if you like even numbers like I do, that's kind of nice, versus 70.5. But it eliminated a planning option that a lot of people use called the stretch IRA. And the idea there is, if you want to let that IRA to keep on paying to your kids after you pass away, under the old way, you could have it stretched out over their lifetimes. And that could be 30, 40 years, just depending on when, you pass away and how old your kids are. So the law changed that. They say no more stretching it out over 30, 40 years. You have to now do it within a 10-year period. There are some exceptions for disabled kids and minor children, but really the results of this shortening the time period, there are at least two I see. One is too much too soon. You remember the old story of the prodigal son. The kid got too much too soon, and it really didn't end up well for him. Well, eventually it did, but immediately it really didn't help him, and that's a great story about an estate plan gone bad. The other thing is your heirs will pay higher taxes, because now you're compressing the payout from, say, 30 or 40 years to 10 years. They're going to pay higher taxes on that because it's more income coming in onto their tax return. So if you have this in your plan where you're thinking, I want to leave my IRA to continue paying out to my heirs after I pass away, or with a husband and wife after a survivor, there are some charitable options to consider. I'm going to touch on two. One is outright bequest to charity, and one is something, actually it's two of the same thing, a charitable life income plan. Let's talk about the first one, the outright bequest to charity. Sometimes we working with donors and say, Congress never really meant for an IRA to be an inheritance plan. It's really a tax time bomb. Either you're going to pay taxes it or they're going to pay taxes on it. You cannot avoid that. Well, there is one way to avoid it. If you have any charitable inclinations through your estate plan, leave the charity the IRAs, the qualified retirement assets, because charities are tax exempt. They do not pay income taxes. And leave the kids the stocks, the bonds, the vacation home on, Orcas Island, whatever it may be, because, they're not going to pay taxes on that inheritance if it's within certain limits. So again, best way to accomplish your charitable bequest. Also, it's simple to do. You really don't even need an attorney. You're just filling out a beneficiary designation form. I mean, it may cost you 55 cents for a postage stamp, but it's simple to do and it's changeable as long as you live, as long as you have mental capacity, you can modify that plan, change it. But again, if you have charitable inclinations in your estate plans, these are the best assets to leave to charity, just from a pure tax planning standpoint. And frankly, I've worked with people who bifurcated it. They say, well, I'm going to give charity half and I'm going to give my kids half. Whatever works within your planning and your goals, it's very flexible, this option. The other option is we talk about, and again, I talk about the prodigal son, or some good friend of mine in the business calls it the creative spender scenario. You get a big bunch of money. If you ask my parents, I was pretty good with money when I was a kid, but I still have the picture of me standing next to that red Porsche 911 at my Uncle Rudolph's house in Germany. And if I got a lot of money, that red Porsche 911 will be sitting in my driveway probably, but so how can you protect against that creative spender? And I think, Jeff, you made a comment earlier about older, younger generations. Have you noticed there's a difference in values and a difference in spending and saving? And I have 4 boys. One of them is just a spender. 2 of them like to save. In fact, they have money here at Integrity Bank. Let's put more money in there, Dad, make money. But you want to protect them from themselves. So if you want to leave an IRA or not any other qualified retirement plan really to your kids after you pass away, there is a charitable solution. We call it the Charitable Stretch Trust or Charitable Stretch Annuity. And what you can do is you name a charitable trust, let's say in this example, as a beneficiary of your IRA when you pass. And in this example, let's say the plan is worth $1 million. Trying to pick some round numbers here. You can say, okay, when I die or when the survivor, the spouse, and I die, this goes into this charitable trust I set up ahead of time. And then you get to dictate the terms of the trust. In this case, the person said, I want to pay out 5% a year for their lifetime. You can either do lifetime or you can do 20 years. I've helped people do both. It really depends upon what you want to accomplish, age of the kids and whatnot. And so this trust over its term will pay out $50,000 a year, $25,000 each. And if you think about that, that's probably not enough to make them want to quit their job, but it's probably enough to help them out with expenses, be it for the kids or remodel, whatever it may be. It's a nice little supplement to have, but probably not going to get the prodigal son scenario in this case. And then once the trust term ends, be that when the survivor passes away or if they did a term of years or 20 years, let's say, then the remaining principal goes to the charities you've named in the trust. And I like to call this, I sometimes call this a prodigal son trust or the give it twice trust. The idea of giving it twice, you're giving twice. You're giving income of $3.5 million in this example to your kids. You're giving the principal, which we assume grows about $1.6 million, to the charity. So you've given it twice to both. So again, if you have an estate plan where you say, I want the IRA to go take care of the kids, at least spread it out using a charitable trust. You get to give it twice. They're still going to get the income like you intended. It may be longer than the 10 years that we're now limited to, which is not a bad thing. And you get the added benefit of giving something to your favorite charities when that trust is over. So just something to consider moving forward. This obviously is not for the current year tax planning, but it's definitely an estate planning strategy worth considering for yourselves. So that's my update. I'm going to hand it back over to Jeff, and I'm going to mute my microphone.
Actually, keep your mic live.
Oh, okay.
And if you just advance, there you go. Okay, so that was the Q&A time. So, Nikki, I'll first look to you to see if you've got any, and then I'll look to the audience. And while you all are typing in or thinking, I'm going to ask Michael a question. So, you mentioned about the tax time bomb of the IRA.
Yes.
Because the stretch has gone away. Are there things other than cash that can be put into your solution, your Give It Twice trust?
Wonderful question. Yes, I've actually helped parents or grandparents do that where perhaps it wasn't the IRA, but it was another asset. I want to leave an inheritance to my heirs, kids or grandkids. But again, you have this prodigal son scenario, I call it, where they may not be quite ready to get a big lump sum inheritance. And so this Give It Twice trust is a great way to even spread out inheritance over a term that you get to choose to help protect the kids from themselves while still providing for them. So it doesn't necessarily have to be an IRA or an asset such as that. It could be any asset. Again, the goal is spread out their inheritance and protect themselves and do something good for the charities that you're passionate about.
And then one other question, because you gave the solution, the 55-cent solution, I think, of just putting a designation to charity on your traditional IRA.
Yeah.
Can you combine that with a QCD strategy while you're alive?
You can. I've actually helped people do that. Again, that's where you're funding it with a beneficiary designation at your passing. So yes, you can. I think I answered this question. What's nice is Jeff's going to get that audio working. There's, in my field of charitable gift and estate planning, we bring the charitable component into the whole financial, that clock that you had of income, retirement, estate planning, charitable giving. There are a lot of wonderful tools that our tax law allows us to use to go beyond just planning for yourselves, but also for charity, where it's really a triple win, a win-win-win.
So I'm going to join you on your microphone.
Oh, did your microphone?
I have technical snafu there. And open it up to see again if there's any questions here in the audience about the topics that we covered. Yes, Joe.
The required minimum distribution to charity. I know you didn't talk about it, maybe you can mention something about that. And again, you have to do it a certain way to take advantage of it. But there's also, living in Colorado, there's a lot of things out there where you get more bang for the buck. You don't just get, well, in this, you don't get the deduction. However, if you give charities that are out there, state sponsored, whether it's the child tax credit or the, what am I thinking, downtown?
Enterprise zone, stuff like that, yeah.
Credit. The child tax credit is 50%. So the enterprise zone is 25, up to 20 or 25%, with a certain amount given. That's something I think that should be mentioned, in that you can get more bang for your buck. Whether you save on your taxes or take that money that you saved on your taxes and also give that.
Yeah, so let me just turn the question to you, but let me repeat it for the audience.
Okay.
So the question is, yes, there are federal tax deductions, but there are also additional benefits to some charities which actually have greater than a state tax deduction. They would have a state tax credit. And here in Colorado, there's a number of them. We mentioned enterprise zones. We mentioned the child tax credit. So the question really is, how do you factor that in if you're wanting to do qualified charitable distributions? Can you take advantage of both with a QCD? I'm going to answer the question from a donor advised fund perspective, because for sure, well, I'd say for sure is too strong. Most likely, no. From a donor advised fund, because you've given up ownership, custody, and control of that money, that actually isn't coming from you, it's coming from this entity, the donor advised fund. So you would not be able to take advantage of the state tax credits. As far as qualified charitable distributions, I believe the answer is exactly the same, that you as an individual would not be able to take advantage of the state tax credit, and it would be better to receive that money as a required minimum distribution. But I'm going to turn it over to you to see if you've got any knowledge differently than that.
That's a lot. No, that's a fantastic question, Joe. And I don't know the answer directly. It's something I'd have to get back to you on. I mean, I use the qualified, I do it for the Springs Rescue Mission and Salvation Army downtown, but I lump them together. But I really don't have a definitive answer, but it's one that I'll have to research and get back to Jeff. It's a great question, and I just don't know. I would think that I'm getting the deduction on the federal level for my gift to, say, the Springs Rescue Mission. I'm getting a credit from the state of Colorado. That's an interesting question. I'm going to have to sort that out and get back to you.
I'll tell you, my gut feel is that it's similar to the donor advised fund answer, that I don't think you would be able to double dip on that if it's coming at the state level. If it's coming as a QCD. And so that's where you might want to work with an advisor to take a look and say, hey, would I be better off taking the required minimum distribution and then making a charitable donation to the state entity that also gives a tax credit? And the answer is probably yes.
Well, if we use up that required minimum distribution, and I still want to give elsewhere, I can do that.
Yeah. And so you can always give more than the required minimum distribution calls for. So you might have a required minimum distribution of $10,000, no prohibition against you doing QCDs for $10,000 and then giving out of other income sources for more, or doing a QCD up to $100,000 if you were so inclined. So just because your RMD is lower doesn't mean you can't go higher on your qualified charitable distribution.
An example of that is, let's say you get $1,200 and you don't need it.
Right.
And you give it to those charities that should get a tax credit for.
That's right. Yep. So again, just the idea that if you do take the required minimum distribution yourself, and you're doing so in order to both get give a contribution to one of these state entities that offers both a federal deduction because it's a 501c3 as well as a tax credit, that may be truly the best of all worlds in terms of, so QCD is not a panacea. It's not going to be the best answer every time, but I think Michael said it. I agree. It really is a tremendous way to give, but you do need to know about these things like additional state level tax credits.
And whenever we talk to people, just to close the book on that, and I will look up the answer, try and get you, Joe, is, we're talking charitable giving in an isolated thing. Everything has to be done in the context of your overall tax return and plan. I mean, we can talk about these really nifty ideas, but how does it fit into your overall tax return and plan? And that whole state credit thing does add an interesting twist. Now you've got me curious. We may have you up next year, Joe. You can talk about that. Other questions?
Yes.
Kind of a dumb question, but I have to ask it. I was widowed and was real worried about becoming a bag lady until my husband didn't have life insurance, died young. So, you have a goal in your 40s and your 50s to reach a certain point where you can be, look at your retirement as being, okay, I made it. This is where I am now. So at 66, I'm looking at my IRA thinking, maybe I don't need that IRA. Maybe I've got my Roth and everything set up right now. I'll be okay. So at what age generally does the typical person start looking at these kind of bigger donation type scenarios?
Well, you may see one thing is you got to look at repeat the question. Oh, sorry. The question was, at what age, if you're not 70 and a half or 72, when should a person start looking at these charitable giving strategies? Well, I would say for sure when you hit those ages, but it would be good to think about it beforehand. Now you know what is possible. So I would just say, but knowing that those ages, and for the charitable thing, it's 70 and a half. They haven't changed that to 72. I'm not sure why, but I mean, it's good to know about it now. But as you get closer and talking with your financial advisor, I'm sure he or she can look at your cash flow needs and take it further. Jeff?
Yeah, that's what I would say. It really is independent of the individual or the couple. You really have to look at these things holistically. And, while sometimes, a smart charitable giving strategy isn't going to be smart tax strategy, many times it is. And we want to work those two together. Similarly, some people may wish to be more generous than their bank accounts allow, right? And so a financial advisor is going to help come alongside and say, well, let's taper that a little bit, maybe do more volunteer and less giving of assets or cash. But to your specific point, I think the question would be, hey, let's look holistically at what your spend rate is, what your assets are, and let's take a solid look at whether or not you can give more aggressively out of those IRAs and still feel confident that you're going to make it for the long run. The one thing you didn't mention in your question was fear of being a bag lady. We don't want that fear to come back. Now that you're financially stable, right, we don't want that to come back. We want you to be generous and we want you to live a generous life, but, within the confines of what the asset base that you have, to do it wisely. And that really is a financial planning discussion.
I would add one more thing, kind of a tangent. You talk about how the bunching and people were very afraid that new law was going to discourage charitable giving. But I always encourage people, don't let the tax tail wag the dog. People will give, and people have given. I have a book on the history of taxes. They've given even when there wasn't tax incentive. People are going to give because they're passionate about whatever that charitable cause is. We're showing you some tax-wise ways to give, but just because the law has changed, I can't take a deduction. People are still giving, and are giving. Giving continues to go up because you take these surveys, probably like the polls we take today these days. Saving taxes, like way down our list. So having said that, though, what Jeff and I are talking about is you're going to make a charitable gift. Let's see the most tax-wise way to make that gift. Whether you get it, that enough said there. Nikki, we have a question?
I do. The question is, if I do a donor advised fund with integrity, is there a fee?
Yeah, I'm glad for this question because I meant to make that point. If I do a donor advised fund with integrity, is there a fee for that? The answer is only non-profit 501c3s can custody donor advised funds. So integrity is not a custodian of donor advised funds. I believe Wycliffe Foundation is.
Wycliffe is, and probably the biggest donor advised fund in the world is Fidelity Charitable. A lot of the some of those brokerage houses have set up a charity just to do donor advised funds. But Jeff is right. Only a public charity can actually administer a donor advised fund.
So back to the question then, where integrity would come in is if you decided to do a donor advised fund, we could manage, most likely, depending on who is the administrator of the fund, we could manage the funds in your donor advised fund until you're ready to distribute. And for that, we would charge an investment management fee, just like we charge an investment management fee on other monies. There will be a small fee from the donor advised fund administrator, and it differs based on who you go with, what that fee is. At a place like you mentioned, Fidelity, I think it starts at 60 basis points. Other nonprofits that administer donor advised funds start at about 100 basis points or 1%. But you can shop that around if you're so inclined. And you don't have to invest the money that's in the donor advised fund with your integrity advisor. But if we did do it, then yes, there would be a fee on that.
And I would add, there's so many. It's not quite a commodity, but there's a lot of charities, even locally here. There's two or three that are more of a community type foundation where you can put the money in, and I'll just say one thing about donor advised funds too. I mean, sometimes the knock against them is, oh, people put money in and they don't distribute. But on average, people are distributing between 20 and 25% of the gift is going out versus a private foundation where it's 5%.
Yeah, that's
But,
a really important point
yeah.
because that was a real fear
Yeah.
that people would just, use it as a lockbox, put it in there, and it never goes to the ultimate charities. But to Michael's point, at a macro level, at any individual donor advised fund level, it might be 0 1 year, but at the macro level, 20 to 25% annually is what that distribution rate is.
I discourage barn building, I call it. Get it out.
Yeah.
But great question.
Yeah.
Other questions?
So the CARES Act goes away in 2020.
Correct. The question is, does the CARES Act go away in 2020? Yes, it's just this year.
Will there be something to replace that next year? And what, depending on the election, what could happen with some of these other tax rates?
Well,
Some of these other charitable giving kind of things.
the question is, one, will the CARES Act go away in 2020? Yes, it's just for the short-term fix. And the second question was, depending on the election, what do we foresee happening moving forward? I know one of the candidates has talked about increasing taxes, doing away with the capital gain carry forwards. So I'd say one of the candidates is much more, let's increase the taxes than the other. But again, who's in power, right? Who has the Congress? Who has the presidency? But I think one of the candidates is very much for increasing taxes. The other one is cut taxes. We'll probably leave it alone.
Yeah, I think it really does come down to the results of the election, and specifically whether it's a divided government where we've got different parties still controlling the Senate versus the.
Might that impact the charitable giving kinds of things?
That's a great question. I know in the history of taxes and changing things, charity's been left alone a lot. I mean, if nothing else, the changes I've seen have been more to encourage giving. Some in the last 10 years, a lot of the tax laws have encouraged it versus discouraged it. So, who knows? But I suspect since we've had the income tax since 1913, charitable giving has always been a kind of a part of the American culture and who we are as people. And we gave over, hundreds of billions of dollars every year. We give voluntarily.
2% of GDP every year gets given to charity. So I think that's one of the reasons why the government tends not to tinker with it too much. But honestly, we don't have a crystal ball any more than you. So it really depends on who's in power and the laws that Congress writes.
I mean, some of the laws will sunset, like the estate tax exemption will sunset in 2025. Right now it's about 11.6 per person. That's going to go back down to 2 or 1 million. That'll sunset in 2025. That'll probably affect charitable giving because there's a lot of estate planning strategies one can use with charitable tools. But that's 5 years out, so we'll see.
Do you think the 10-year for heirs, that'll ever change?
Question is 10 years for heirs, so the stretch IRA going away, so it's 10 years. Will that ever change? I would never say never, but seeing how that came about through a Republican administration, I don't think that's likely to ever be reimposed back to an unlimited. But that's, again, pure speculation on my part.
Also, it's more revenue for the government.
Sure.
So I to Jeff's point, I find it hard to see that they're going to say, oh, we made a mistake. Even in the charitable stretch illustration, which I shared with you all, the heirs are going to pay income taxes in those payments. But again, now it's not 10 years. It's expanded to their life, let's say, or 20. So, but I doubt they'll ever change that, but who knows, because it's a source of revenue.
Is there a question, Joe?
Yeah, not to get into politics or anything, but there's still a scenario out there. On the first day that if Joe Biden is elected president, if that he's going to do away with the Trump tax policy, isn't that part of the Trump tax policy?
Yeah, so the question is, if Joe Biden were to become president and he said he's going to do away with the Trump tax policy, which would be wouldn't that affect the 10-year stretch because that was part of the Trump tax cut? And the answer is certainly could possibly. my hunch is he won't throw out the whole thing. He'll pick and choose, different pieces of it. And what will come back are some of the advantages that came to businesses, but some of those things that actually increase the tax roll probably won't be reinstated. And I think, Michael, you bring up a great point. It's very important to keep in mind, why does the government have required minimum distributions on IRAs in the first place? It's because they want their tax on it, right? Why is the government limiting, the stretch IRA to 10 years? They want their tax on those dollars. So follow the money, and it answers a lot of the questions. But at the same time, I give them credit because the qualified charitable distribution is saying, but if you don't need the money, we're not going to ever tax that money so long as you give it directly to charity. We're okay. That's a win-win in there.
Nikki has an online question.
Thank you. It says, Jeff talks about giving capital assets to charities who avoid leakage. Can the capital assets be given to a donor advised fund and then the distribution be spread out from there?
In fact, I would say absolutely you should give them to the donor advised fund. If you tried to give, let's say, a piece of land to a charity, certain charities are going to be able to handle it. Wycliffe certainly could. But your local charity probably isn't equipped to be able to receive a piece of real estate that they're not going to use for their purposes. So we're in Colorado. Hey, I've got this great piece of land out in Kansas. Well, why don't you sell it and give us the cash? Is probably the answer you'll get. But through a donor advised fund, regardless of where the administrator is located, they would say, most likely, sure, we can take that real estate, we can sell that real estate, you're going to avoid the capital gains, and then how you distribute that money from your donor advised fund, completely up to you, the time frame.
I just to add to what you're saying, I'll tell people, Wycliffe on my shirt, which I'm wearing a Wycliffe shirt if you can see me. My wife and I support several charities, and I never pretend that if you work with me, it's all going to go to the charity, for which I'm employed. My job is to listen to what you want to do, show you the best way, and then it's up to you and your wife and the good Lord, whatever, to decide where to go. And what's wonderful about donor advised funds, you can give a lump sum of an asset like real estate. I just helped a lady do an apartment thing last year, and then spread out the giving to all the charities that you feel passionate about, not just to the one who helped you set it up. I never pretend that, because I've only met one person in 32 years doing this work that had one charity. We all give them more than one.
But Nikki, back to the heart of the question. Yeah, a donor advised fund is really great for being able to spread out the distributions to charities. It's really great for being able to receive non-cash assets, and a whole host of other things. I talked about some of them, the timing, matching it up with a high tax year to do your bigger giving in those years to offset. So it really is a powerful tool. And Michael kind of touched on it when he said Fidelity Charitable is the largest donor advised fund. In fact, if you were to look at a list of the top 10 charities in the United States, if I were to go out on the street and ask people, what do you think the largest charity is in the United States, they'd probably say the Red Cross or, something similar to that. Salvation Army maybe.
It's up there, yeah.
But it isn't. It's Fidelity Charitable. And in the top 10, 5 of the largest charities now are donor advised fund programs. So this is an idea, even though it hasn't been around all that long, 30 years or so, is really caught on, and it's really a powerful tool.
And I would add, it's every man's personal foundation.
Yeah.
Before people had to be uber wealthy to set up, even to run a private family foundation. The donor advised fund gives us, Jeff and I, all of us could set one up. We don't have to be super wealthy, and we can get even better benefits than a private foundation. So I think many reasons why they become popular, but anyone can set one up. Many charities, many administrators have no minimum balances. Some do. But it's a great way for anyone in the country really to have their own family foundation, I call it, even though that's not the legal term. It's just a great giving tool for people.
Yeah. And in that legacy aspect that I talked about, that's why we kind of still think of it as a family foundation, because it does give you that ability to more easily involve the rest of the family in how those monies get distributed. And generally, every generous person I know wants their children to be generous, right? And so this is a tool that helps facilitate the teaching of that generosity.
So simple question, long answer. Raises a lot of other answers.
Well, unless there's other questions here, I think that ends our time. But I appreciate you all being here in person. I appreciate everybody who joined us online being available remotely. This is being taped, and so it will be available on our website. But you've got mine and Michael's contact information there, so we'd appreciate any way that we can help you. It would be our honor. So thank you, Michael, for joining us.
It was a pleasure. Appreciate y'all joining us.
All right. Bye then.
Bye-bye.